My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Finance as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Bonus tip. If you want to be 100% safe. For theory, master FDI theories, OLI paradigm, and portfolio diversification. For numericals, APV-NPV based foreign investment evaluation is most likely. Unit 4 first important short question is: what is the OLI paradigm? The OLI paradigm is a theory that explains why companies invest in other countries. It was developed by John Dunning and is also known as the eclectic theory. OLI stands for O. Ownership advantage. The company must have something special like a brand name, technology, or expertise. L. Location advantage. The foreign country must offer benefits like cheap labor, large markets, or resources. I. Internalization advantage. The company should do the business itself instead of giving it to others to control quality and earn more profit. Example: Infosys sets up an office in the USA. O. Infosys has skilled Indian IT professionals. L. USA has big clients and high-paying markets. I. Infosys runs the office itself, not through a US partner. Easy trick to remember. Own something, choose best location, do it internally is equal to OLI. This model helps explain smart global business decisions. Next important short question is: 2. What is international portfolio diversification? International portfolio diversification means investing in different countries' financial markets instead of just one country. The goal is to reduce risk and increase returns. When you invest only in India, your money is affected by Indian events like elections or inflation. But if you invest in stocks or bonds from other countries, like the USA, Japan, or Germany, your risk is spread out. If one market falls, another may rise and balance the loss. Example: an Indian investor puts 1 lakh rupees in stocks from India, 50%, US, 30%, and Japan, 20%. If Indian stocks drop, US or Japan investments may still perform well. Easy tip to remember. Don't put all your eggs in one basket, spread across borders. This strategy helps protect your money from local market ups and downs and gives a chance to earn from global growth. That's the power of international portfolio diversification. Next important short question is: 3. What is the theory of comparative advantage? The theory of comparative advantage explains why countries should trade with each other even if one country is better at producing everything. It says, a country should specialize in making goods it can produce more efficiently at a lower opportunity cost and import the rest from other countries. Example: India is good at making textiles and the USA is good at making aircrafts. Even if the USA can make both faster, it's better for India to focus on textiles and trade them for aircrafts from the USA. This way, both countries benefit and get more than they would by producing everything themselves. Easy tip to remember. Do what you do best and trade for the rest. This theory, given by David Ricardo, supports global trade and helps countries save resources, time, and money. That's why international trade exists, because comparative advantage creates win-win situations. Next important short question is: 4. What is the difference between foreign direct investment and portfolio investment? Foreign direct investment, FDI, and portfolio investment are two ways foreigners invest money in another country, but they are very different. FDI, foreign direct investment. This is when a company or person invests directly in a business in another country to control or manage it. Example, Tata Motors buying Jaguar Land Rover in the UK, they control and manage the business. Portfolio investment. This is when someone buys shares, bonds, or securities in another country just to earn profit without control over the company. Example, a US investor buys 10 lakh rupees worth of shares in Infosys on the Indian stock market. Easy tip to remember. FDI is equal to direct control. Portfolio is equal to profit only. FDI is long-term and stable, while portfolio investment is short-term and flexible. Both help in the growth of a country, but are used in different ways by investors. Next important short question is 5. What is international cash management? International cash management means managing the cash and bank balances of a company that operates in multiple countries. It ensures that the company has enough money in the right place, at the right time, and in the right currency. Multinational companies deal with different currencies, tax rules, and banking systems. They must plan how to collect, transfer, and use cash across countries efficiently. Example: Infosys has offices in the USA, UK, and India. It receives payments in dollars and pounds, but most expenses are in Indian rupees. Infosys must manage how to convert and move the money without losing too much in exchange rates or bank charges. Easy tip to remember. Right cash, right country, right time. Good international cash management helps companies avoid delays, reduce costs, and make global payments smoothly. It keeps the business running smoothly across borders. Next unit 4. Long questions. First important long question is 1. Explain the FDI theories. FDI, foreign direct investment, means a company or person from one country invests directly in business operations in another country, like building a factory or buying a company. There are many theories that explain why FDI happens. Let's understand the main ones. 1. Theory of comparative advantage. This theory says countries should focus on what they do best, low cost, high skill, and trade for the rest. Example, India has skilled IT workers, so US companies invest here to save costs. Memory tip: do what you do best, trade for the rest. 2. Market imperfection theory. Sometimes markets are not perfect. There are barriers like taxes, tariffs, or lack of information. Companies invest directly to avoid these problems. Example, a Japanese car maker sets up a plant in India to avoid import duties. Memory tip: when markets don't work right, invest on site. 3. Product life cycle theory. FDI depends on the product's stage. New products are made at home, and once demand grows abroad, companies invest overseas. Example, a US company first sells gadgets in the US, then opens a unit in Europe. Memory tip: as product grows old, go global and bold. 4. Internalization theory. Companies prefer to keep control instead of giving rights to others, like licensing to protect quality, technology, or brand. Example, Coca-Cola opens its own bottling plant in India instead of giving it to someone else. Memory tip: do it yourself to protect your wealth. 5. Oli paradigm, eclectic theory. Developed by John Dunning, it says FDI happens when 3 things are present. Ownership advantage, brand, tech. Location advantage, cheap labor, raw material. Internalization advantage, better to control than outsource. Example, Tata Motors buying Jaguar, UK. Memory tip, own it, choose the best location, do it internally is equal to OLI. Conclusion. FDI theories explain why companies go global. To save costs, beat competition, reach markets, and control business. Understanding these theories helps us see how big companies make smart investment decisions. Next important long question is: 2. Describe the modes of foreign direct investment, FDI. Foreign direct investment, FDI, is when a person or company from one country invests directly in another country's business by setting up or buying a business. There are different modes, ways, of FDI, and each has its own features. Let's understand them one by one. 1. Greenfield investment. This means starting a new business or factory from scratch in a foreign country. Example, Hyundai sets up a car manufacturing plant in Chennai, India. Advantages: full control, local job creation. Disadvantage: high cost and slow process. Memory tip: greenfield is equal to new field. 2. Brownfield investment, acquisition. This means buying an existing company or plant in a foreign country. Example, Tata Motors bought Jaguar Land Rover in the UK. Advantages: faster entry, brand already known. Disadvantage: may have hidden problems, debt, bad image. Memory tip: brownfield is equal to already built ground. 3. Joint venture. In this mode, a foreign company partners with a local company. They share profit, risk, and control. Example, Maruti Suzuki, Suzuki, Japan, and Maruti, India worked together. Advantages: local knowledge, shared risk. Disadvantage: risk of disagreements. Memory tip: joint is equal to 2 points. 4. Mergers. When two companies combine to become one. This may happen between foreign and domestic firms. Example, Vodafone merged with Idea in India. Advantages: synergy, faster growth. Disadvantage: culture clash, complex process. 5. Franchising and licensing, limited FDI. In some cases, a foreign brand allows a local company to use its name or products. Example, McDonald's gives licenses to Indian partners. Advantages: low risk. Disadvantage: less control. Conclusion. Companies choose the FDI mode based on cost, speed, control, and risk. FDI helps both the investing company and the host country to grow and benefit. Final tip. Greenfield grows, brownfield buys, joint joins, mergers merge, franchise flies. Next important long question is: 3. Explain the scope and functions of international financial management. International financial management, IFM, is the process of handling financial decisions for a business that operates in more than one country. It includes managing money across borders, handling foreign exchange, and taking investment decisions in global markets. Scope of international financial management. 1. Foreign exchange management. Managing the risk of currency value changes. Example, Infosys earns in dollars, but pays salaries in rupees. So, it must manage exchange rate risks. 2. Foreign investment decisions. Deciding where to invest abroad for better returns. Example, Tata Group investing in the UK or Africa. 3. Capital budgeting for global projects. Evaluating overseas projects using NPV, IRR, and APV methods. Example, evaluating a new factory in Germany. 4. Global financing decisions. Raising funds from international markets, like issuing bonds in dollars or euros. Example, an Indian company listing on the New York Stock Exchange. 5. International tax planning. Reducing tax burden legally by using global tax rules. Example, Google uses tax-friendly countries for operations. Functions of international financial management. 1. Managing currency risks. Use tools like forward contracts, options, and swaps to protect from currency losses. 2. International working capital management. Managing day-to-day cash, receivables, and inventory across countries. 3. International capital structure planning. Deciding how much to raise from debt versus equity in global operations. 4. Profit repatriation. Deciding how and when to bring profits earned in foreign countries back to the home country. 5. Compliance with global laws. Ensuring all financial decisions follow local and international regulations. Final summary. International financial management helps multinational companies make smart money decisions across countries. It deals with currency, investments, cash, tax, and laws. Easy tip to remember. Right money, right country, right strategy, that's IFM. It's all about using finance skills to grow globally and manage risks wisely. Next important long question is: 4. A project costing 250 million is expected to generate after-tax cash flows of 10 million rupees a year forever. Risk-free rate is 3%, asset beta is 1.5, required return on markets is 12%, cost of debt is 8%, annual interest costs related to project are 2 million rupees and tax rate is 40%. Calculate the adjusted present value of the project. Adjusted present value, APV. Let's calculate the adjusted present value, APV, of a project step by step. Given. Project cost is equal to 250 million rupees. After-tax cash flows is equal to 10 million rupee per year forever. Risk-free rate is equal to 3%. Asset beta is equal to 1.5. Market return is equal to 12%. Cost of debt is equal to 8%. Annual interest is equal to 2 million rupees. Tax rate is equal to 40%. Step 1. Calculate cost of equity, K, using CAP. Use the formula. K is equal to risk-free rate plus beta times market return risk-free rate. So, K is equal to 3% plus 1.5 times 12%, 3%. K is equal to 3% plus 1.5 by 9% is equal to 3% plus 13.5% equals 16.5%. Step 2. Calculate base case NPV, assuming all equity financed. Use the perpetuity formula. NPV is equal to cash flow K is equal to 10 million rupees 0.165. 60.61 million rupees. This is the value without debt, pure equity project. Step 3. Calculate tax shield on interest. Tax shield is equal to interest times tax rate is equal to 2 million rupees times 40% is equal to 0.8 million rupee per year. Now calculate present value of tax shield, perpetual, discounted at cost of debt. PV is equal to 0.8 million rupees, 0.08 is equal to 10 million rupees. This is the benefit of using debt, since interest is tax deductible. Step 4. Calculate adjusted present value, APV. APV is equal to base case NPV plus PV of tax shield is equal to 60.61 million rupees plus 10 million rupees is equal to 70.61 million rupees. Final answer. Adjusted present value, APV, is equal to 70.61 million rupees. Easy tip to remember. APV is equal to NPV, no loan, plus tax shield from loan. This method clearly shows how much value is added due to using debt in financing. Next important long question is 5. Explain the rationale, barriers, and home country bias in international portfolio diversification. What is international portfolio diversification? It means investing your money in different countries' financial markets, stocks, bonds, etc., instead of putting it all in your own country. This helps to reduce risk and increase returns. Rationale: why it is done. 1. Risk reduction. If one country's market crashes, others may still perform well. Example: if Indian stock market falls but US market rises, you still earn. 2. Higher returns. Some foreign markets may grow faster than your home market. Example: an Indian investor earned big by investing early in China or the US tech sector. 3. Currency gains. If the foreign currency strengthens, your investment value increases in rupees. Example: USD becomes stronger, so your US investments grow in rupee value. Memory tip: don't put all eggs in one country's basket. Barriers, problems faced. 1. Lack of information. It's hard to understand foreign markets and company data. 2. Exchange rate risk. If the foreign currency weakens, you may lose money. 3. Political risk. Unstable governments or strict rules can hurt foreign investments. 4. High costs. Brokerage, taxes, and currency conversion charges are higher. 5. Time zone and language issues. Monitoring markets becomes difficult. Home country bias. This means investors prefer to invest more in their own country, even when better options are available abroad. Example: an Indian investor puts 90% of his money in Indian stocks, ignoring US or European markets. Why it happens? Familiarity with local companies. Fear of foreign risk. Belief that local markets are safer. Final summary. International portfolio diversification helps in reducing risk and increasing profits, but barriers like lack of knowledge and home bias stop people from investing globally. Easy tip to remember. Go global, reduce trouble, but study well before taking the double.